Greetings, friends, and welcome to the Financial Game. As always, Ferdinand Roño and Jose Miguel Crespi are here with you to discuss the latest news in the real estate world, both in Puerto Rico and the United States. In the first episode, we talked a little about what we see for 2026 based on analysts' research, our own experience, and what we should expect. The result is that we expect a positive year in 2026. I think Jose and I agree that we're not as optimistic about returns as many analysts and banks are, but we do believe it could be a good year, possibly with high single-digit gains, and with some kind of opportunity to enter the market. The real estate market has gone through some not so great times. We've had a couple of tough years in the market. We need to perform comprehensive reengineering, complete redesign, strategically reposition our assets, and carefully move our cash flow around. Shift the situation because the issue of affordability is still, Jose, very much present. Now, we have observed and analyzed that in the most recent economic data points we have received, in September and October, there was a significant and noticeable pivot. Pivot means that we started to see consolidation and stability no longer continuing to decline. For example, in the market where we are, and we've said this clearly, from the peak to where we are now, prices have dropped between 7.7% and 10.4%. That's the reality. Possibly a median price of around $400,000 went down to $380,000, $370,000, and even reached $365,000 at the bottom of the market. Now they've gone back up again to around $380,000. But we saw an important shift, which is the number of pending sales in the market. The market is about supply and demand. And we started to see that inventories are beginning to dry up. Why? Because many investors started to panic and stopped investing. Many home builders stopped building. Many small home builders abandoned their projects or put them on hold. And so demand is still strong. What's happening? During that period of time, guess what? Mortgage rates from 7.50 to 7.75 have now dropped to 6.05. And if you have good credit, you can still get 5.75. And everything seems to indicate that the trend is downward. Right now, I'm going to talk about two very important news items that have happened recently and that are mixing into the mortgage market. But yes, Jose, I do see potential interested buyers. In our residential construction firm, we had approximately 27 different projects underway. Out of those 27, almost all were either fully rented or sold. And there are about 4 or 5 units left specifically, and now 2 of them just went under contract. One of the contracts fell through because of financing issues. The deals fall apart at the bank. Remember, it's not the same to have a monthly payment now. The monthly payments for an average home, say $400,000 or $425,000, you're talking about a monthly payment of $2,200 to $2,300 when you include insurance and taxes. And so, in that regard, you'll see that not everyone is going to qualify. Remember that people have expenses, you have childcare, and childcare is extremely expensive here in the United States. You have the cost of living. You have the issue of what is possibly now a political topic in the midterm election.
You mentioned something very important, Ferdinand, and I want to emphasize and go over that. Being 2025, it was a difficult year for the real estate market. As Ferdinand mentioned, Pentax Homes sold its inventory, sold the inventory it released, what was finished being built that year and put on the market. It moved. Yes. That's the beauty of real estate. That's what's great about real estate. The fact that you can have price fluctuations, you can have affordability issues, you can have excess inventory at certain times, but it gets absorbed because, as you mentioned, the demand is there and you have the flexibility to move it however you want as long as you're in a good position. Pentas, as I mentioned before, controls the process. When you control processes, you control costs. Losses of 7.5, 9, 10, 11% in price can still be absorbed. And that's what allowed Penta to move inventory.
We also created different structural programs like List to Own and a series of things that allowed us to
move to keep things moving in the cycle. So it's absolutely crucial and essential that we do not seize our momentum. The ongoing, continuous process of constructing high quality residential homes is strategically positioning the company so that what we anticipate in 2026 will be a significant transitional year, moving toward a highly positive and profitable outcome. And we're looking at 2027, the following year, as a year of strong momentum again, a new cycle within the real estate cycle. Not having stopped and continuing to build has put us in a position where we will keep bringing inventory to the market
Yes, and you'll also see, I believe there will be appreciation and a good market.
in that area. I'm already receiving, Ferdinand, practically every single day now, an email, a text message, or even a phone call from various investment bankers, mortgage brokers, or professional MLOs saying, we're already down at 5.5, we're at 6, or even 5.75% right now. In other words, that phenomenon is already going to happen, and when rates start to reach attractive numbers where you can have that buyer who during 23, 24, 25 bought property or financed property at over 6.5%, 7%, 7.5%. They'll start to re-enter the market, whether it's through refinancing or by selling their property and buying another one, etc. So you create that movement again, and we're definitely getting ready for that.
Well, I think 2026 was the bottom, at least in our market. I think it happened between September and October of last year. Second, several events have taken place. Right now, the Fed has in its forecast, not at the moment, I don't think the Fed is going to touch rates right now.
I have the data here, and right now the Fed funds futures show no change in January, no change in March, and no change in April. At least for the first three Fed meetings of the year in February, there isn't one. Absolutely. January, March, and April will remain as they are.
And if you consider the political situation where the current issue stands right now, what's happening between the White House and the Fed? Me, Powell, I wouldn't move anything. I'd stay calm. I'm going to leave an economy with all three mandates possibly up to date. Employment, a stable economy, and inflation trending downward. And then I step down. Right? Maybe it does go down, but I don't know. But we are seeing something in the mortgage market, which I really don't understand what it has to do with that. And what's happening is there's an effect where the president issued a mandate for a mandatory purchase of 200 billion in mortgage-backed securities. That's called quantitative easing in English. Quantitative easing was implemented by Bernanke during times when the economy was slow to push interest rates down and encourage movement and speed in the economy. That's exactly what's happening right now in the mortgage market. That's why you're getting those calls. Because the mortgage market, even though it hasn't been fully reflected in the price, in the interest rate pricing, is sensing that these moves, for example, pushing quantitative easing, which means that the Reserve, Fannie Mae, and Freddie Mac, the companies that buy mortgage-backed securities, have to buy 200 billion from the market. That increases the supply more than the demand, and that causes rates to go down, just like what happened with the Fed during what was called quantitative easing, mainly pushing treasury bonds downward.
It's the same mechanism, but with notes.
With the notes, it's more targeted toward the mortgage market for home buyers. Of course, it's an election year, so the statistics have been reviewed. There's no doubt that Gen Z, yes, they are voters from 19 and 21. You're a millennial, but for example, my daughter Maria Isabel is Gen Z. And if you look at the political statistics which were shown recently, Trump was plus 10 with that generation. Now he's minus 30. So I understand that's why you see the movements in interest rates on credit cards. The CAPIR table. At 10,
That's one that was released. They released the one that prevents institutions and private equity funds from buying up properties en masse.
properties. That's why it disrupts demand.
Okay?
Yes, it has the mandate to pretty tough situation. For Fannie and Freddie to buy property. Does he want to force the Fed to lower rates? Generally speaking, I mean, I don't think that's going to happen, but I want to tell you that there is a movement that's being noted specifically, and I think right now I was checking the monthly payment to talk to our people in Arroyo de la Bichuela. If you have a $500,000 house, right? 6 months ago, that's why I'm saying that, in my opinion, my gut feeling is that on October 7th, there was a shift, even before these recent news events happened. Because I'm looking at the data, the absorption, which I always mention on this show, where a $500,000 home used to cost you $2,800 a month for PT, principal, interest, taxes, and insurance. Now, with these changes, with just a slight decrease from what we've seen, the PT is already at $2,500, $2,450, according to what I discussed today with a mortgage banker. You're already seeing a reduction of between $250 to $300 a month in the affordability calculation.
And Ferdinand, locally here, for example, in Florida, there's lobbying and pressure to reduce property taxes at the state level. Yes. And there's lobbying and pressure to reduce property insurance as well and to address the insurance issue. Yes. With homeowners associations, with condo associations, and especially in South Florida where the buildings have, excuse my Puerto Rican way of saying it, but there's a bit of a mess with the homeowners associations. Yes, it's a mess. All these projects, all these ideas, all this lobbying, this push, as they start to materialize, maybe not all of them will, but they all favor a boost in the real estate market.
No doubt about it, definitely. And it's intentional. Yes, I mean, I don't want you to think I'm trying to talk politics here. What happens is that right now, this is an election year, it's very political. Because historically, cyclically, in the stock markets, midterm elections set different trends, whether it's for change or for confirmation. And there's no doubt that in election years, the current government is going to try everything possible to try to motivate and make appealing moves. And when I saw that number, Jose, I won't lie to you, I was shocked. I mean, I'm talking about a shift from plus 10 in 2025 to a recent survey showing minus 30. And this is the population that votes. This is the population that wants a home. This is the population that is worried about their future eventually. And they're young professionals. So we have to pay attention to that. Of course, from my own professional perspective and based on my extensive analysis as a dedicated builder, a strategic developer, and an experienced fund manager, I certainly do utilize this data as a significant point of reference during my analysis, but I do not rely on it as a primary factor for my final decision-making process. But I do have to keep in mind where things are heading, where the POC is going, and
lastly, let's not lose sight of the fact that the president is a real estate guy.
absolutely.
He has his own projects and his own investments. And if the ongoing affordability issues continue and interest rates remain at these elevated levels and potential buyers continue to hesitate and hold back, then his various projects will likely be negatively impacted. Therefore, he's going to play for his own team.
Let's see, I think 2026 will be an interesting year. Our analysis shows that 2026 should be much better than 2025. And 2025 was not a bad year for us. I mean, 2025 was a very negative year for the average home builder. But in our case, we were able to modify, adjust, rebalance, and I think we did quite well in terms of absorption and movement.
We're at a good point to allocate capital, Javier Races, for those people who are looking, for those evaluating where to invest or considering strategies. This is a good and optimal time to get into real estate and keep going. As I always say, diversification is key. So until
next time, well, I think we'll see in the next month in the upcoming episodes in the Financial Game Special Edition.
Until next time.